Welcome to the HIT Podcast, H.I.T, Human Resources, Insurance, and Technology. I'm your host, Toby Kennedy. As we do every week, we are dropping into your feed with what I hope are bite-sized, digestible, well-curated conversations going on in the space. This week's episode is brought to you by Montage Insurance Solutions. And without any further ado, we pick up where we left off. We have Spencer Smith in studio discussing all things self-funded. We talked about stop-loss contract provisions and now get into captives in the captive world. Join us. This is part 2 of 3 in our series with Spencer Smith, and we pick up where we left off last week. What you just mentioned a second ago with ag accommodation being a good fit for especially captive type groups or even those mid-market employers, right?
Yes.
I want to use that as a pivot point to dive into what the heck is a captive? Sounds like a scary name. You know, I'm a maybe 100 life or 300 life or 400 life group. Am I too small to even self-fund or to be in a captive? Am I the right fit? Kind of talk to me about what is a captive? What makes them special? Who's a good fit? Talk to me all things captive. Oh, captive, my captive.
Oh, captive, my captive. So we always joke that the word captive we all hate. We actually try to avoid saying captive a lot because it sounds like you're being held hostage. And when we get into who we are as a company, I'll tell you, we don't hold anybody hostage. These are annual contracts. But the actual purpose of a captive, just like you were diversifying your portfolio in a 401k, and you're rather than picking and choosing individual stocks, you're spreading your risk out amongst a much larger pool of options, right? Or of equities, if you will, that you could buy. And then the thesis is if I have a longer term horizon in which I'm trying to get a return on my 401k, or I'm managing my healthcare spend, a bigger pool of diversified risk is actually more stable over time. But I think the easiest analogy, and I love to use this analogy, is if you go bowling and you're not a very good bowler like I am not, you put those bumpers on the side of the lane. It's not going to guarantee you roll a strike, right? But it is going to guarantee that you don't roll a gutter ball. Think of a captive as putting those bumpers on the side of the bowling lane so you don't roll a gutter ball when you go self-insure.
Yeah. So let's kind of define this a little bit here, where you guys basically say, hey, we're an organization, and what we've done is collect a bunch of individual employers that are like-minded and forward-thinking and awesome in ways that we have vetted and determined to be awesome. And all these guys come together, and now we can take this giant block of companies to a stop-loss carrier. And we can say to them, hey, you know those provisions that you would have either charged through the nose for or wouldn't even have made available to this company. They're now a part of our big consortium, if that's an okay word. And, you know, everybody in our block gets these preferred contract languages. And I think that to me often arises as my number one initial conversation point about when a group should consider a captive. So if we're considering self-funding anyways, let's talk about what the captive can bring to the table, because there's language that you either wouldn't have otherwise gotten or you would have been priced out of.
Sure. If you think about it, the basic reason you would join a captive is that scale that I just described and you just articulated as well. So kind of give you some context. We've got almost 4,000 employers in this captive pool that we have, and it's somewhere around $1.7 billion of stop loss that's accounted for. So if you have $1.7 billion or so.
$1.7 billion of, and about how many members?
That would equate to 1.2 billion belly buttons. So we count belly buttons, which includes the members themselves.
So you said 1.2 million
belly buttons
across 4,000 employer groups, equating to rounding up to $2 billion in stop loss premium. Right?
Yeah, so, hopefully we'll get to $2 billion at the end of the year.
Yeah. Well, I'll do what I can. But so it's like, you know, when you're an employer that thinks it has 175 employees, you join this 1.2 million belly button pool, and now all of a sudden, you know, you swing a bigger bat.
Yeah, absolutely. And it sort of answers the question. Employers that want to be self-funded have explored it before, and they go, man, that seems too risky, or that's too volatile, or we're not big enough. All those concerns, those objections you probably hear very regularly. A captive is designed to ease those concerns because it adds a big element of predictability over time. Then when you do those things, you get the provisions, you get the no new laser, the rate cap, the advanced funding, all those things built in inherently as part of the equation, where a stop loss carrier is very likely not going to offer that to an individual 50 life group, 75 life group, et cetera. But the other part of that, which I think is as important, is then you have people beating down the door to say, I want access to 1.2 million lives. I want to work with you. I want to bring my dialysis solution or my
Before you get
yeah,
into the point
yeah,
solutions, which I love and I do want to get into, I think you're right, and that's honestly that where you're going is the second thing I talk about with
okay,
the strength of the captive. But before we get there, just to kind of help people further unpack, like when you're again, I know it's a weird word and we're talking about captive, but so as an employer, I just want to try to be linear. Like they're this random one-off employer out there and they buy in, and what they buy into is sort of your big pool, and you go to the insurance carriers, the stop loss carriers, and you not only negotiate the more favorable language, but there's the captive layer that I want to get into and
yeah,
I want to touch upon, which is these employers sort of they buy in, right? It's kind of their membership to the country club or however you want to call it, but they buy in with dollars that they get back. It sits on their balance sheet, whatever. But there's this kind of pool of money between the employers joining your program, the employers buying in, the employers being a part of this that sits as kind of a float sometimes. And it means that the captive layer, in a sense, is, if you want to put it this way, protecting the stop loss layers. And when you have a stop loss that gets an added layer of protection, that means it's got a lower risk. That means it's got a lower premium. So you're able to insulate to a degree what ultimately pierces the stop loss because of a captive layer. And I just kind of wanted to unpack that piece a little bit more because I think it's another machination as to why captives work.
yeah. I would say you're leading me towards one of our favorite analogies as a company, which is our Home Depot bucket analogy. I don't know if you've ever heard it before. I'm sure you have, but if you imagine, if the employers or folks that are listening imagine a Home Depot bucket on the middle of their desk or on the table, our job is to take all of those 4,000 employers premium, put it in that proverbial bucket, and then as claims hit the stop loss and go into the captive layer, we pull out of that bucket to pay the liabilities of those claims. With that 1.7 billion or whatever the exact number is, you have a lot more predictability. It's a lot more stable. The employer knows there's plenty of premium in total to pay all of those claims. And we target somewhere around a 5 to 7% profit margin within that humongous layer. So what does that mean for the employer? Renewals are more predictable, usually lower. That means there's profit share components when the captive runs well, and it's done so for the last decade. And you can start thinking about, well, I'm not shopping stop loss every 12 months. I know where I'm going to be. I know my worst case scenario. I know the probability of what's going to happen next year. And then when we get into the second piece, which is the cost containment, I'm going to now spend all of my effort and energy trying to solve the claim problem itself. So it protects the employers to be able to focus on that.
And you said two things in there. You said we aim for a 5% profit margin, but then you also said you get money back when things run well. And I want to kind of touch upon, so when you say 5% profit margin and you guys are Pareto, is that for Pareto, the CEO, and Pareto makes the money, or who's the owner within Pareto? Talk to me about the ownership and why that aligns incentives.
I wish I could say it goes to me and my paycheck, but it unfortunately does not, because that'd be a great return. But it's there, and I would say maybe I pose a question back to you. Why do we want it only to be 5%? Why do we not want it to be 30% profit?
Yeah, it's the same reason why you don't necessarily want a huge refund from the IRS, right? I don't want to overpay on the front end and give you a basically zero interest loan and then you pay me back on the back end, right? I want to pay what's appropriate, but what I'm kind of getting at is the members own
Yeah.
into Pareto. You know what I mean?
Yeah, well, that's why I say I was very specific to say what we target as a profit margin, because it's easy to go, hey, we got a 30% profit margin. Here's all this money back in the form of profit share, but it's tax inefficient. And we don't want to overcharge for premium on the front end. And so by having such a huge number inside of that layer, we can get very precise about that target. We want to return some profit every single year, if we can, to the members as a reason why they would want to be a part of the captive, one of those reasons. But we don't want a huge number coming back, because then they're going to get taxed. It'll get expensed a couple times. It's a way to turn $1 into 55 cents over time. So that's why it's a very small margin for error, but we don't want too big of a margin. We also don't want the inverse, which again, we haven't had happen in 10 years, which is there wasn't enough left in that layer. And then we have to go back and ask for more capital later on.
Well, and not to return the toot the horn favor, but the reason Pareto can do this uniquely or uniquely well is size matters. You have so much premium and so many members that we've teased the law of large numbers a few times. But what we're trying to say is, I don't know if one single human being is going to have, a cancer diagnosis, but if you give me 1 million people, I could tell you approximately how many cancer diagnoses you're going to have, right? So any one individual risk is highly volatile, and the more and more and more and more data you take in, the more we can say, okay, now on average, we know we're going to have, X amount of premature babies and Y amount of rolled ankles. Yeah. And we can do this stuff because we have such scale. So that, I think, is, to me, an important unpacking of what a captive is. Frankly, why Pareto is a little bit different, but captives in general, and why groups might want to look at captives. That's all the time we have for you this week on the show. Thank you so much for joining us. Thank you to our sponsors, Rula, Excel Health, TrueHue, Montage Insurance Solutions. We're blessed to be here. Thank you guys for keeping the lights on. That's all the time we have on this part 2 of our 3-part series. Please join us next week for the thrilling conclusion of our conversation with Spencer Smith. Join us next week. Join us every week. And until next week, make this the best week yet.